At times when interest rates are low, investors are looking for alternative ways to generate a yield and an income. And so private credit is a way in which they can gain exposure to an asset class that is not necessarily correlated to the way in which other publicly traded securities might trade. So for instance, in private credit, there's a range of things that people can do to generate returns. So I think of private credit in our market in Australia, it's a developing market as a result of some of the regulatory changes that are impacting on the banks. And as a result of that, that's creating opportunities for investors that they've not had before. In our world, in private credit, it really can span everything from very high investment grade, publicly listed corporates, all the way through to more aggressive lending strategies. So there are a range of vehicles and choices available for investors to access the asset class, but each of them will give them different risks and return outcomes. So it's important that investors really understand the nature of the assets that they're investing in and the kind of returns that those assets should generate. Not all private credit is the same, however. You know, a lot of markets develop or expose investors to private credit. Some of those are more akin to publicly traded securities. So, for instance, investors are seeing opportunities to invest in global high yield out of the Australian market at the moment. Some of those are investments that are probably more akin to publicly traded securities than genuine privately negotiated transactions. Where you're lending directly to the companies and you're negotiating those transactions direct with the companies that you lend to. Look, I think in private credit, investors are really receiving a premium for what is the illiquidity of the asset class. It's in Australia in particular, it's not an underlying asset class where the assets are traded, so it's not a means to buy and sell private loans over an exchange. So you tend to find that when you lend money to a company, you're looking to really lend on a hold to maturity basis. So if you're lending for 3 years or 5 years, you're really lending for that term. And so the kinds of returns that investors would generate would usually be comprised of a number of features. So it might be a base interest rate, usually a floating rate, usually a rate that's in excess of the RBA cash rate. So it's usually a rate that's struck off BBSW or BBSY as the base rate. Then you usually add a margin for the credit risk or the scarcity of capital that's applied. And then there are usually fees and charges that are applied to the borrower. And so all of that comprises the return elements that are available to an investor. And really the returns that an investor might generate could be anywhere between 300 basis points over bank bills all the way through to the mid-teens. It really depends on the risk profile of the underlying asset that the investor is exposed to.